Members of the committee, Andrew Musick with the New Jersey Business and Industry Association, which represents 20,000 companies here and 1.2 million employees in the state. Just want to thank you and the members of the committee for allowing me to speak on S-982 today. The bill requires members of unitary business groups to file combined reports of corporation business tax. Our three main concerns with the bill are increased complexity and uncertainty, and the difficulty in predicting state revenues, and third, New Jersey's numerous safeguards that are already in place to ensure that companies are paying accurate amounts of corporation business tax. Combined reporting can introduce significant complexity and uncertainty for taxpayers, creating a system of winners and losers. Companies may experience an increase, a decrease, or it may leave unchanged the taxable income reported on a combined return. Legitimate differences are likely to arise between taxpayers and auditors concerning the scope of the unitary group, which often results in expensive, time-consuming litigation for both companies and states. And additionally, transitioning to combined reporting requires a significant investment by the state taxation department. Even if more dollars were to be generated, they may well be more than offset by the additional time, energy, and expenses associated with compliance, audits, appeals, and litigation. In regards to state revenue estimates, and as noted in the OLS fiscal estimate, combined reporting has uncertain effects on a state's CBT revenues. Reliably estimating the state revenue impact of combined reporting is a very challenging task. The National Conference of State Legislatures commissioned a report that was released in 2010, and the report studied the effectiveness of combined versus separate reporting and found that there was no evidence that combined reporting enhances state tax revenues. And two states have experienced similar results. In Minnesota, it was concluded that combined reporting did not increase revenues at all in either the short or the immediate term after reviewing the initial estimates after implementation. And in Maryland, the state collected data for 5 years to measure the impact of adopting combined reporting, and they found that had it adopted combined reporting, the state would have either gained or lost revenue depending on economic conditions, and as a result, Maryland chose to not enact combined reporting. And finally, as also noted in the OLS fiscal estimate, New Jersey already has a number of safeguards and tools in place to ensure that companies pay accurate amounts of CBT. For example, the New Jersey Director of the Division of Taxation can require a tax filer to file a consolidated return. Additionally, under the current statute, taxpayers are not permitted to deduct interest and royalty expenses paid to affiliates unless a specific exemption applies. States that have already enacted these so-called add-back provisions, like New Jersey, can expect significantly reduced additional revenue from combined reporting, as these add-back provisions achieve much of the same revenue effect as combined reporting. Therefore, New Jersey already safeguards against taxpayers exporting taxable income beyond New Jersey's reach. Once again, we respectfully oppose the bill. Thank you for your time, and I'd be happy to answer any questions you may have. I've also brought with me today one of my leading tax practitioners, Dave Gattowski, a partner with Reed Smith, who's happy to answer questions as well.